Imagine you're maybe at an airport. Busy place. You see someone walk through customs. Maybe they've got a really expensive watch, a designer bag. Looks normal enough.
Mm-hmm.
Or, you're just scrolling online, maybe see a news headline. Huge amount of cash seized in some raid, or some big-name person suddenly facing charges.
Right. Happens all the time.
Exactly. But what if behind all that, behind these sort of separate moments, there's this hidden flow? Like a dark financial stream where money from, well, everything, drug trafficking, terrorism, is being carefully, meticulously scrubbed clean.
Yeah.
Made to look legitimate.
Yeah, disguised.
Okay, let's unpack this then. Today we're diving deep into the really intricate world of anti-money laundering. AML, as it's known. It sounds maybe a bit dense, maybe a bit technical, something for the lawyers or the big banks.
It can seem that way.
But it's absolutely vital. Really, it's fundamental to the integrity, the stability, the basic trustworthiness of our whole global financial system. We're basically talking about the constant effort, often unseen, to stop criminals, terrorists too, from taking money they got illegally.
Dirty money.
Dirty money, exactly, and making it look completely above board, cleaning it, laundering it.
What's really interesting here, I think, is that our goal with this deep dive isn't just to, throw a ton of jargon at you.
Right.
Think of it more like a shortcut, a guided tour, maybe. We've gone through the source material. It's mainly a financial services textbook. Very clear, focused on UK and EU rules.
Good solid stuff.
Exactly. And we've pulled out the really important bits, the key insights, maybe some surprising facts too. The aim is to cut through that complexity, show you how this financial cat and mouse game works, and give you those aha moments.
The bits that make it click.
Right. So you actually get it, you feel well-informed, but without feeling totally overwhelmed by detail. It's about understanding not just what money laundering is, but why these systems matter so much and, how they're actually trying to protect all of us.
Exactly. So let's start right there. Let's strip away the sort of dramatic headlines for a minute and really get into the basics. What is money laundering at its core? It's more than just a phrase, isn't it? It's a process.
It absolutely is.
Yeah.
At its most basic level, money laundering is about filtering the proceeds, the money, from any kind of criminal activity. And it's really important to stress this definitely includes financing terrorism, filtering that money through legitimate financial systems.
Okay.
The ultimate goal, like you said, is to make those illegal funds look legitimate, make them seem like they came from a clean, legal source, and crucially, make it incredibly hard to trace them back to the actual crime.
Right, giving it a new identity.
Exactly. It's like trying to give dirty money a complete makeover, a totally new, untraceable identity, so criminals can use it freely, without anyone suspecting where it really came from.
And when we say sophisticated techniques, we're not just talking about, the movie image of a suitcase full of cash, are we?
Oh, definitely not. I mean, that might happen, but the reality is usually much more intricate, more subtle.
Yeah.
Our source material points out some methods that show real ingenuity almost.
Yeah.
A kind of, twisted creativity from the criminals trying to clean their money. Like, take one of the most common ones, structuring, also known as smurfing.
Ah, yes, structuring. That sounds technical, but maybe simple in practice.
It is, yeah, and that's why it's so effective. It's kind of insidious in its simplicity. So imagine a criminal has a big pile of cash, illicit cash.
Okay.
Instead of walking into a bank and depositing, say, 100,000 pounds, which would immediately raise red flags, trigger reports.
Great, alarms would go off.
Exactly, they break it down into lots and lots of smaller deposits, often deliberately kept just below the reporting threshold, maybe 9,000 pounds here, 9,999 there.
Sneaky.
Very. And these small amounts are deposited into many different bank accounts. Could be across different branches, even different banks entirely. Sometimes they use other people, Smurfs, to make the deposits for them.
Hence the name.
Precisely. It's slow, it's painstaking, like a drip feed into the system. It's designed to fly under the radar, avoid suspicion, and create this really fragmented, messy trail that's incredibly hard for investigators to piece back together.
Wow.
It looks like just normal business revenue, maybe, or lots of small, unrelated transactions. The cleverness is in the patience, the sheer volume of these tiny, seemingly harmless deposits.
That really does show that cat and mouse game you mentioned. Okay, what about other tactics? You mentioned investments.
Absolutely. That's another classic area. Think about something called placement through investment. So a criminal might make what looks like a perfectly legitimate large investment, maybe buying shares in a company listed on the stock exchange, or perhaps buying luxury property, or even high-value art.
Things that hold value.
Exactly. But the key part here is the speed, how quickly they get out of that investment. They might buy the shares and then sell them again very quickly or flip the property within a really short time frame.
So it doesn't look like they held it for long.
Right. And on paper, the money they get back now looks like, well, it looks like profit from selling shares
Yeah.
or proceeds from a property sale, a legitimate capital gain.
I see.
The money has gone through this sort of superficial transformation. Its dirty origin is masked behind this seemingly normal investment activity. It uses the liquidity, the speed, and the sort of assumed legitimacy of financial markets to create a clean paper trail.
Okay, here's where it gets really interesting, you said. There was one in the source about using loans, mortgages. That sounds particularly clever.
It really is. It's a neat trick. Imagine a criminal arranges a mortgage, maybe a substantial business loan. Looks perfectly normal on the surface.
Okay, standard financial activity.
But then, very quickly, they pay it off, often with large amounts of cash, or funds moved in a complex way.
Ah, paying off a big debt quickly.
Exactly. Now, on the surface, it looks like, oh, here's a responsible borrower settling their debts ahead of schedule.
Right.
But hang on. Where did that huge chunk of cash suddenly come from to wipe out a major loan so fast?
Good question.
What the criminal has done, effectively, is use their illicit cash, their dirty money, and despised it as legitimate loan repayments. It creates this kind of circular flow where the dirty money comes in to seemingly pay off a clean debt.
Making the dirty money look like the source of a responsible action.
Precisely. It's that kind of creative misdirection, finding loopholes, finding vulnerabilities in the system. It really is this relentless game between the financial institutions trying to spot this stuff and the criminals trying to stay one step ahead.
And it's not just like theoretical, is it? These financial firms, they're actually spotting a lot of this.
They are. A significant amount, actually. A huge proportion of suspicious transactions are identified by financial service firms themselves. And it's not just the massive global banks we hear about.
Right, it's broader than that.
Much broader.
Right.
We're talking building societies, finance companies, credit card providers, money service businesses, bureau de change, places like that. Even professionals like accountants, tax advisors, solicitors, estate agents.
Anyone handling money, basically.
Pretty much.
Yeah.
Anyone involved in financial transactions is potentially on the front line. They act as the first line of defense, the gatekeepers. Their vigilance is absolutely crucial because they are the channels, the conduits that dirty money tries to flow through.
So it's not just, oh, it would be good if they spotted this. They actually have a legal duty to do this, right?
Absolutely.
Yeah.
It's not optional. Under UK law, we're talking specifically the Proceeds of Crime Act 2002, POCA as it's known, the Terrorism Act 2000, and also the influence of various EU money laundering directives, which shaped UK rules.
Okay.
These firms have a clear, legally enforceable obligation.
Right.
They have to put measures in place to mitigate the risks. They need robust internal controls. They need to train their staff properly to spot red flags and report suspicious activity.
It's a core responsibility.
Foundational, really,
Yeah.
for maintaining trust in the whole system. And failure to comply. That can lead to really severe penalties, fines, reputational damage, even criminal charges for individuals. It underlines just how serious this duty is taken.
And on the UK's front line, the sort of national agency leading this fight, particularly against the big organized crime stuff, that's the National Crime Agency, the NCA.
Yes, the NCA.
Yeah.
If we connect this to the bigger picture, the NCA isn't just another police force. It's the UK's lead agency, specifically tasked with combating serious and organized crime. And that kind of crime is almost always linked to illicit finance. Money laundering, massive fraud, bribery, corruption, often spanning across borders.
Right, international scope.
Exactly. So the NCA's job isn't just about catching criminals, it's about protecting the very foundations of our economic trust, both here and internationally. What makes them effective is their unique position. They bridge intelligence gathering and operational activity across lots of different agencies and even countries.
Cooperation is key.
Absolutely essential. Financial crime doesn't stop at the border, so the fight against it can't either. The NCA works very closely with international partners, other law enforcement agencies, financial intelligence units, big bodies like Interpol, Europol. It's a global, coordinated effort. They're really integral to protecting the UK's financial system and its reputation. A lot of their work is behind the scenes, dismantling these complex criminal networks that threaten economic stability.
Okay, so we've got a handle on what money laundering is, some of the sneaky ways it's done, and who's on the front lines trying to stop it. Let's dig into the legal foundations now. The rules that give these firms and law enforcement the power to act. Starting with that big one you mentioned, the Proceeds of Crime Act 2002, POCA.
Right, POCA is a huge piece of legislation, really transformative when it came in. Its main goal is to hit criminals where it hurts their wallets, to strip them of the profits of their crimes, and make it easier for authorities to seize assets bought with dirty money.
Okay.
It sets out three main money laundering offenses. They're distinct, but they overlap, designed to cover different ways someone might be involved in the process. Understanding these is key to seeing how comprehensive the law tries to be.
All right, so the first one is concealing criminal property. That sounds pretty straightforward, hiding the loot, basically.
It sounds simple, but it's actually much broader than just, say, stuffing cash under the mattress.
Oh.
This offense applies to any property money, assets, anything of value that someone knows or suspects comes from any kind of criminal conduct. But it's not just about hiding it. POCA makes it an offense to disguise it, convert it, like turning cash into jewels, transfer it, moving it to someone else or another account, or even remove it from the jurisdiction, sending it overseas.
So actively manipulating it.
Exactly. It's about actively manipulating the appearance, the form, or the location of the wealth to hide its criminal origin. Think about setting up complicated webs of shell companies to shuffle funds around, or converting cash into diamonds, art, something less traceable, or wiring money through multiple banks in different countries.
Layering, you mentioned earlier.
Precisely.
Yeah.
This is often part of the layering stage, creating layers of complexity to distance the money from its dirty source,
Right.
making it almost impossible for investigators to follow the trail back.
Okay, that makes sense. Then the second main offense under POCA is arranging. This sounds like it catches the helpers, the facilitators.
That's exactly who it targets, and it's a really crucial part of POCA. It widens the net beyond those directly handling the cash to include the enablers.
Right.
The offense of arranging happens when someone enters into an arrangement, any kind of plan or deal that they know or suspect will help someone else acquire, keep, use, or control criminal property.
So setting things up for them.
Yes, facilitating the process. For example, imagine a professional, a lawyer, an accountant, maybe a financial advisor. They suspect their client's money isn't legitimate, but they still help them set up, say, a complex offshore trust or a shell company, or maybe they handle a property purchase designed to hide the real owner.
Even if they don't touch the dirty money themselves.
Even if they never physically touch the illicit funds. By providing their professional expertise, their legitimate services to help disguise or move the criminal property, they become complicit. They are arranging. It's a powerful tool against the professional enablers, the brains behind sophisticated schemes.
Got it. And the third main one, acquiring, using, or possessing criminal property. This sounds more direct, again, like maybe catching the people who just benefit from it.
It is pretty direct, yes. It's a criminal offense for someone to acquire, get, use, or simply possess property if they know or suspect it is or represents the proceeds of crime.
So just having it is enough.
If you know or suspect its origin, yes, it targets that direct involvement. Receiving dirty money into your bank account, buying things with cash you suspect is illicit, even living in a house you know was bought with criminal funds. The key element is that knowledge or suspicion.
Right.
Unlike concealing or arranging, which usually involve actively doing something to disguise or facilitate, this captures the perhaps more passive, but still illegal, act of just having or benefiting from the dirty money. Together, these three offenses create a really strong legal barrier, trying to catch money laundering at every stage, from active manipulation to simply benefiting from it.
Okay, so those are the offenses targeting the criminals or their direct helpers. But POCA also puts duties on people within the system, right? Particularly in finance. And failing those duties is also an offense, like failure to disclose.
Yes, this is absolutely critical,
Yeah.
especially for anyone working in what's called the regulated sector, banks, financial advisors, lawyers, accountants, etc. It's a cornerstone of the UK's preventative AML system.
Okay.
POCA introduced this requirement. A person must disclose information about potential money laundering if they have reasonable grounds for knowing or suspecting that someone is involved in it or in terrorist financing.
Reasonable grounds, not definite proof.
Exactly. That's the crucial part. You don't need concrete evidence, irrefutable proof. The threshold is lower. A reasonable suspicion is enough if something feels wrong, looks dodgy, doesn't add up.
Like that quick loan repayment we talked about.
Precisely. If a bank teller, an investment manager, anyone in that regulated sector spots something unusual that raises a red flag, they have a legal duty to report it. Usually, they report it internally first to their firm's designated money laundering reporting officer, the MLRO.
Okay.
It means professionals can't just look the other way if they suspect something, even if they aren't involved in the crime itself. It puts a significant responsibility, a burden of vigilance, squarely onto the financial sector.
And then there's the flip side of disclosure, the danger of saying too much to the wrong person, tipping off. Why is that considered such a serious breach? It sounds serious just from the name.
It is extremely serious. Tipping off is the offense of disclosing information to anyone, really, but especially the suspect that prejudice might mess up a money laundering investigation that is happening or even might happen.
Ah, so warning them.
Exactly. Warning the suspect or someone close to them. The reason it's treated so severely is simple. It can completely destroy an investigation, often before it even gets properly started.
How so?
Well, if you tip someone off, what are they going to do? They'll immediately move the money, destroy evidence, maybe shred documents, change their story, or simply disappear.
Right, cover their tracks.
It completely undermines law enforcement's ability to follow the money trail, seize the assets, and catch the criminals. You're essentially giving the criminals a crucial head start to get away with it.
That makes sense why it's a major offense then.
Absolutely. That's why it carries its own significant penalties up to 5 years in prison. It reflects the direct damage it causes to investigations and the whole effort to fight financial crime. It's seen as a fundamental betrayal of the system.
Okay, moving on from POCA, there's also the Terrorism Act 2000. This obviously has a specific focus, but it's closely linked to AML, isn't it? Especially around the money side.
Very closely linked. While POCA deals with the proceeds of any crime, the Terrorism Act 2000 has specific provisions focused squarely on preventing and disrupting the financing of terrorism. First, it's important to understand how it defines terrorism itself. The Act gives a broad definition. It talks about the use or threat of serious violence against people, serious damage to property, endangering life, or seriously disrupting electronic systems. But crucially, it has to be for the purpose of influencing a government or intimidating the public, and it must be for a political, religious, racial, or ideological cause.
So the motivation is key.
Yes, the motivation combined with the serious action or threat. It's a wide definition to capture various forms of terrorism.
And how does that connect directly to the financial side, to money laundering concepts?
The Act specifically makes it a criminal offense to be involved with terrorist property. This includes the retention or control of such property. And similar to POCA, this isn't just about holding it. It includes concealing it, disguising it, moving it out of the country, transferring it to nominees, any way of handling or manipulating it.
So similar actions to money laundering, but focused on terrorist funds.
Exactly. It criminalizes handling funds or assets connected to terrorism. This creates a direct parallel to the general money laundering offenses, but with that sharp, critical focus on terrorist financing. It recognizes that money is the lifeblood of terrorist groups. Cutting off the funds is essential to stopping their activities.
And what counts as terrorist property under the Act? Is it just cash for attacks?
It's defined very broadly again. It includes money or any other property that is likely to be used for terrorist purposes, or property that's come from acts of terrorism, or even property obtained through acts carried out for the purposes of terrorism, like fundraising, even if it looks legitimate initially.
So pretty much any asset linked to terrorism in any way.
Pretty much. Funds to buy weapons, yes, but also money raised through front charities, money used for propaganda, travel, training, or just assets owned by people involved in terrorist groups. The aim is to disrupt any financial flow that helps or supports terrorism.
Right, okay, so those are the key UK laws. But as we've said, this is a global issue. Money flows across borders instantly. That brings us to the EU money laundering directives, MLDs. Now, obviously, the UK isn't in the EU anymore, but these directives still matter, don't they? They shape the landscape.
They absolutely still matter. Hugely influential. Even post-Brexit, the principles and requirements laid down in these EU directives are deeply embedded in UK law. They form the basis for much of the UK's AML framework over many years.
So we're kind of aligned, even if not formally part of new ones.
Largely, yes. The UK aims to maintain equivalent or even stronger standards to remain a credible international financial center. So understanding the evolution of these directives helps understand the foundations of the current UK system. It's been a layered approach over time.
Let's start with the third money laundering directive then. That was back in 2005. What were the key things it established?
The third MLD was a big deal at the time. It really aimed to harmonize rules across the EU, creating a common understanding. It did this partly by providing clear, standardized definitions for key terms.
Like what?
Well, property, for example. It was defined incredibly broadly. Assets of every kind. Tangible things like buildings or cars. intangible things like patents or copyrights, movable, immovable, plus legal documents that give you title to assets like deeds or share certificates. Basically, anything of value.
So criminals couldn't just switch from cash to something else easily.
That was the idea, close loopholes. And it defined criminal activity, too. It referred to crimes listed in the Vienna Convention, that's mainly drug trafficking, but crucially, it allowed each member state to add other criminal activities relevant to them.
Flexible.
Yes, and criminal property was defined as property coming from criminal conduct or from an alleged offense that resulted in some benefit. These shared definitions were vital. They created a common legal language across the EU, making it easier to cooperate on cross-border investigations and prosecutions. You need everyone working from the same playbook.
Okay, fast forward a bit to 2017 and the fourth money laundering directive. This one felt like a real step up in intensity, didn't it? What were the big changes here? What issues was it trying to fix?
It really was a significant upgrade. It came about because, well, criminals were getting smarter, using new methods, and the old rules weren't quite enough. A major introduction was the mandatory risk-based approach.
Risk-based. What does that mean in practice?
It means firms couldn't just apply the same checks to every single customer or transaction. They were required to actively assess the specific money laundering and terrorist financing risks associated with their particular customers, the products they offered, the countries they operated in.
So tailor the checks.
Exactly. More checks, tougher checks, what we call enhanced due diligence for higher risk situations, maybe simpler checks for very low risk ones. It's about focusing resources where the danger is greatest, rather than a one-size-fits-all approach that might be inefficient or ineffective.
What else did the fourth directive bring in?
A much wider definition of politically exposed persons, PEPs. These are people in prominent public positions who are considered higher risk because of potential bribery or corruption.
Right, politicians, senior officials.
Yes, but the fourth directive expanded it. It included domestic PPs, those in prominent positions in their own country, not just foreign ones, and it explicitly included their family members and known close associates. The thinking was that power and access to public funds create vulnerability, regardless of the country's reputation. So banks had to apply extra scrutiny to a much wider group of people.
Okay, that makes sense. Broadening the scope of who needs extra checks. Anything else major?
Yes, quite a few things, actually. It introduced a specific criminal offense for recklessly making false or misleading statements during investigations trying to tackle dishonesty head-on. And really crucially, for the very first time, tax crimes were explicitly brought under the AML umbrella.
Ah, tax evasion now counts as money laundering.
Effectively, yes. The proceeds of tax evasion were officially recognized as criminal property that needs laundering. This was a massive change. Before, some countries treated tax offenses differently. This directive said, no, serious tax evasion generates huge illicit funds that flow through the financial system, often funding other crimes, so it has to be part of AML efforts. It also focused on strengthening cooperation between authorities in different EU countries, improving how they share information. And another huge one, beneficial ownership registers.
Right, finding out who really owns a company.
Exactly. This required companies, trusts, and similar legal structures to find out who their ultimate beneficial owners are, the actual people who own or control more than 25%, and to register that information. The aim was to make it public, or at least accessible to authorities and those with a legitimate interest.
That seems like a direct attack on secrecy.
It was. A direct assault on the use of anonymous shell companies and complex structures that criminals love to use to hide behind, trying to lift the veil of corporate secrecy. What's fascinating here is seeing how these directives kept tightening the screws, closing loopholes. That push for beneficial ownership really shows the move towards transparency. It's about knowing who truly controls the money, not just the name on the paperwork.
Peeling back the layers, as you said.
Exactly, trying to reveal the real person pulling the strings.
Yeah.
It makes it much harder to hide.
And then, most recently, the fifth money laundering directive, 5MLD, which took effect in early 2020, this one seemed very focused on new tech and emerging threats.
It absolutely was. 5MLD was largely a response to the changing landscape, the rise of cryptocurrencies, new digital payment methods, and also lessons learned from terrorist attacks, where financing was sometimes done through relatively small, harder-to-track means.
So what did it change specifically for things like electronic money?
It brought in stricter rules. For example, it lowered the threshold for anonymous prepaid cards, those non-reloadable ones. The maximum monthly payment limit was cut to €150. And the thresholds for needing customer due diligence, CDD, on electronic money accounts were also reduced quite significantly. from 250 euros down to 150 euro for standard accounts. And for remote payments, like online transactions, the trigger dropped from 100 euro down to just 50 euro.
Wow, 50 euros is pretty low.
It is. It reflects the concern that even lots of small digital transactions can add up, and that anonymity in the digital space needed tighter controls. So yeah, if you're using certain digital wallets or prepaid cards, the checks might kick in even for relatively small amounts now. It has a direct impact on how easily anonymous, small-value digital payments can be made.
Okay. And did it do more on customer ID generally or those beneficial ownership registers?
Yes, it strengthened the requirements for identifying and verifying customers, specifically encouraging the use of secure electronic identification methods where they're approved, recognizing the shift to digital onboarding. And, importantly, it significantly expanded public access to the beneficial ownership registers. Before, you often had to prove a legitimate interest to see the data. 5MLD aimed to make this information more openly accessible to the public, journalists, NGOs.
More eyes on the data.
Exactly. More transparency, more scrutiny, making it even harder to hide behind corporate structures. It also mandated enhanced due diligence, EDD, those tougher checks for any business relationships or transactions involving high-risk third countries, those identified by the EU or FATF as having weak AML systems, trying to shield the EU system from risks coming from elsewhere.
Now, just to clarify for UK listeners, our source mentions the UK opted out of the 6th MLD, but also says most requirements were already covered here anyway, especially in finance. So despite opting out of that specific directive, the UK financial sector is still largely operating under these kinds of stringent rules.
That's broadly correct, yes. While the UK isn't legally bound by new EU directives post-Brexit, the core principles and many specific requirements from the 4th and 5th directives were already implemented into UK law before departure, or have been mirrored since through domestic legislation.
So we're keeping pace.
The UK generally aims to maintain equivalent, or sometimes even stricter, standards. It has a long-standing commitment to fighting financial crime. So the UK's own legal and regulatory framework remains very robust and largely aligned with international best practices, including those set out in the MLDs. The financial sector here continues to operate under a very stringent regime. The UK wants to remain a leader in financial integrity.
Okay, that clarifies the EU connection. Now let's zoom out again. We've said money laundering is global. That inevitably leads us to the Financial Action Task Force, or FATF. You mentioned them. They sound important, but they aren't like a global police force, are they?
No, not at all. FATF isn't a law enforcement body. It doesn't investigate crimes or make arrests. It's an intergovernmental organization set up back in 1989 by the G7 countries. Its mission is to set standards and promote effective implementation of measures to combat money laundering globally.
And terrorism financing, too.
Yes. Since 2001, after 9/11, its mandate was expanded to include combating terrorist financing, CFT as well. So AML-CFT. It acts as a global policy-making body.
But if they don't enforce laws, how do they have influence? You said it was massive.
Their influence comes from setting the global standards, the FATF recommendations. These are recognized worldwide as the benchmark for how countries should structure their AML-CFT laws and regulations. And then, crucially, FATF evaluates countries on how well they implement these standards.
Peer pressure.
Peer pressure and more. Countries that fail these evaluations risk being publicly named and shamed. They can be put on FATF's gray list, meaning increased monitoring, or, in severe cases, the blacklist, meaning countermeasures are recommended.
And that has real consequences.
Huge consequences. Being gray or blacklisted makes it much harder and more expensive for a country's banks and businesses to operate internationally. It can deter foreign investment, restrict access to global finance. It's a powerful incentive to comply. If we connect this to the bigger picture, FATF really embodies that idea. Financial crime is borderless. So the fight has to be global and coordinated.
So what are their main areas of work? How do they achieve this coordination?
They focus on four main things. First, they study and identify trends and methods in money laundering and terrorist financing. They look at how criminals are using new technologies like crypto or exploiting vulnerabilities in different sectors, keeping ahead of the curve, basically.
Okay, intelligence gathering.
Second, based on that, they set the international standards, those FATF recommendations we mentioned. They cover everything from laws and regulations to the powers regulators and law enforcement should have and the preventative measures financial institutions must take. It's a comprehensive blueprint. Third, they evaluate countries' compliance. They conduct these rigorous peer reviews where experts assess a country's laws and, crucially, how effectively they're being implemented in practice. Are banks actually doing proper checks? Are authorities prosecuting cases? These evaluations result in detailed reports.
Holding countries accountable.
Exactly. And fourth, flowing from those evaluations, they identify high-risk jurisdictions. Those countries with significant weaknesses in their AML-CFT regimes that pose a risk to the international financial system. Publicly naming them on the gray and black lists puts pressure on them to reform. They work closely with national bodies like the UK's NCA too, sharing information and coordinating efforts. It's a multi-pronged approach.
That really paints a picture of global cooperation, driven by standards and evaluation. Okay, let's bring it back down to the practical level again. For you, the listener, interacting with a bank or financial firm, perhaps the most visible part of all this is customer due diligence, or CDD. What does this actually mean for you as a customer? Why do they ask for all that ID?
CDD is really the foundation stone. It's the process firms use to confirm your identity and understand, basically, who you are and what you're likely to use their services for. It's the practical application of the Know Your Customer, or KYC principle.
Okay.
Its main purpose is to stop criminals using fake identities or hiding behind complex company structures to open accounts or make transactions. It's about preventing them from getting access to the legitimate financial system in the first place. And it's not just a one-off check when you open an account. It involves ongoing monitoring, too, making sure your activity still makes sense based on what they know about you, especially if transactions seem unusual or high risk.
So when does a firm actually have to do these CDD checks? It's not for every single little thing, presumably.
No, not for everything. The rules specify certain triggers. The most obvious one is when you're starting a new business relationship, opening a bank account, taking out an investment policy, hiring a solicitor for a house purchase. That initial stage always requires CDD.
Makes sense. What else?
Also for occasional transactions above a certain threshold, even if you're not a regular customer. The trigger is generally $15,000 for a single transaction, or if there's a series of linked transactions that add up to over $10,000, especially if cash is involved. This catches large one-off movements.
And what about specific products like insurance?
Yes, life assurance policies have specific triggers because they can involve large sums and potentially be misused. CDD is needed if annual premiums are over $1,000 or if it's a single premium policy over $2,500.
Oh, okay.
And crucially, overriding all these financial thresholds, CDD is always required if the firm has any suspicion of money laundering or terrorist financing. Regardless of the amount, if something seems off, they must identify the people involved.
Right, suspicion trumps everything.
Absolutely. It empowers them to act on instinct or red flags immediately.
What if they already checked someone's ID years ago? Do they ever need to check again? Or if circumstances change?
Yes, definitely. CDD isn't static. If a firm starts having doubts about the ID they originally collected, maybe it looks outdated or new information casts doubt on it they need to re-verify, or if there's a significant change in the customer's circumstances. For example, if your business suddenly changes dramatically, or you move to live in a country considered high risk, the firm needs to update their understanding and potentially get new ID evidence. It's about keeping the customer profile current and accurate.
It's an ongoing process, then.
It has to be. Risks change, circumstances change.
And when they ask for ID, what are the standard things they usually accept? What are they looking for?
Typically, they want reliable, official documents that are hard to fake and ideally have your photo. So things like a current passport, a national identity card if it has a photo, or a full photo card driving license.
Government-issued photo ID.
Exactly. And for proof of address, they usually ask for something recent, often within the last 3 months, like a utility bill, gas, electricity, water, a bank statement sent to your address, or maybe evidence you're on the electoral roll. The main goal for the firm is to be reasonably sure that you are who you say you are, and that the documents are genuine and belong to you.
Okay, but this brings up a really important point, doesn't it? What about people who genuinely don't have these things? Not everyone has a passport or driving license. Not everyone gets utility bills in their own name. How does the system handle that without unfairly excluding people? This idea of preventing financial exclusion.
That's a critical issue, and it's something the UK regulator, the FCA, takes very seriously. They absolutely recognize that some people, often through no fault of their own, simply cannot produce the standard ID documents.
Like who, for example?
Maybe an elderly person who's never driven or traveled abroad and lives with family so bills aren't in their name. Or someone who's homeless. Or a refugee who's just arrived with limited documentation. If firms rigidly demanded only standard ID from everyone, these people would be locked out of basic financial services, like opening a simple bank account. which you really need for modern life.
So what's the solution?
The FDA allows firms, in these genuine cases, to be flexible and accept alternative forms of evidence. It has to be carefully considered, of course. It might involve checking information against government databases, if possible. Or, significantly, they might accept a letter or a statement from a trusted professional who knows the individual, like a solicitor, a doctor, a social worker, maybe even a religious minister, vouching for their identity and circumstances.
So relying on trusted third parties.
Sometimes, yes. It's about finding a practical, risk-based way to verify identity without creating insurmountable barriers for legitimate people. It's a crucial balancing act, maintaining security against criminals while ensuring fair access for everyone else.
That's a really important nuance. Okay, so once the ID is checked and accepted, what happens to that information? Do firms just shred it?
Oh no, definitely not. Record keeping is incredibly strict. Firms are legally required to keep copies of the identification evidence they collected for at least 5 years after the business relationship with the customer ends.
5 years after you close the account.
Exactly. And they also have to keep records of all the transactions carried out during the relationship, plus any supporting documents, again, for at least 5 years after the transaction happened.
Why so long?
It's vital for investigations. Money laundering trails can be complex and might only come to light years later. Having those historical records allows law enforcement to potentially reconstruct financial activity, follow the money, and build a case. It provides that essential audit trail for compliance checks, too.
I've also heard about credit reference agencies being involved in these checks somehow. How do they fit in? And does it affect your credit score if they do an AML check?
Yes, firms often use credit reference agencies as part of their CDD process. These agencies hold vast amounts of data, and firms can use them electronically to help verify aspects of your identity, like your name, address, date of birth, checking if you appear on electoral rolls, that sort of thing. It's a quick and efficient way to corroborate information.
But does it harm your credit rating, like when you apply for a loan and they do a credit search?
That's a common concern, but no. The type of search done for AML identity verification is different from a credit application search. It leaves a specific marker on your file, sometimes called an anti-money laundering footprint or identity check. But crucially, this type of search is not visible to lenders when they assess you for credit. It does not affect your credit score or your ability to get loans or mortgages in the future. It's purely for identity verification, not creditworthiness assessment. So people don't need to worry about that aspect.
That's good to know. Okay, so we've covered the laws, the global context, the practical checks like CDD. Now let's look at the guardians within the system. The regulators and the key people inside firms who make sure this all happens. Let's start with the big one in the UK, the Financial Conduct Authority, the FCA. What's their main job here?
The FCA is the conduct regulator for, well, almost all financial firms in the UK, tens of thousands of them. A core part of their legal mandate from Parliament is to protect and enhance the integrity of the UK financial system. And a huge part of that is preventing financial crime.
So AML is central to their mission.
Absolutely central. They require all the firms they authorize to have really robust systems and controls in place, specifically designed to stop the firms being used, knowingly or unknowingly, for financial crime. That obviously includes money laundering and terrorist financing.
And how do they enforce that? What's their reach?
Their reach is very broad. What's fascinating is the range of their powers. They set the detailed rules and standards firms must file. They actively supervise firms to check they're complying. They investigate breaches when they suspect rules have been broken. And they have significant enforcement powers. They can impose massive fines on firms, ban individuals from working in finance, issue public censures, and even pursue criminal prosecutions in some cases. They cover the whole life cycle, from setting standards to punishing noncompliance.
A powerful regulator. What specific things do they expect firms to do?
They have clear expectations. Firms need to establish clear accountability, usually meaning a senior manager is personally responsible for AML systems. They absolutely must appoint a money laundering reporting officer, the MLRO. They need a documented risk policy specifically for money laundering, showing how they assess and manage the risks. They must provide regular, effective training for staff on the rules, their responsibilities, and the consequences of getting it wrong. They need to actively educate staff about potential red flags and typologies. And, of course, they have that legal duty to report suspicious activity via suspicious activity reports, SARs, to the National Crime Agency. The FCA oversees all of this and holds firms to account.
And they work with industry bodies, too, like the Joint Money Laundering Steering Group.
Yes, the Joint Money Laundering Steering Group, JMLSG, is very important. It's made up of the main UK trade associations from across the financial sector. Its key role is to produce detailed guidance notes
Guidance on what?
on how to interpret and implement the UK's money laundering regulations in practice. These JMLSG guidance notes are incredibly helpful for firms. They translate the often complex legal requirements into practical steps and industry best practice. While they aren't law themselves, regulators like the FCA and even the courts view them as representing the expected standard of conduct. Following the JMLSG guidance is a key way firms demonstrate they have adequate procedures.
Okay, let's talk more about that role you mentioned, the Money Laundering Reporting Officer, MLRO. That sounds like a really critical position within a firm, the nerve center almost.
It really is. The MLRO is the designated focal point within a firm for all AML and CFT matters. The rules say they must be of appropriate seniority
Why seniority?
because they need the authority and independence to do their job effectively. They need access to information, resources, and the clout to make potentially difficult decisions like deciding whether to report a valuable client without being unduly influenced or overruled by commercial pressures.
Makes sense. And their main job is handling those internal reports from staff.
That's their core responsibility, yes. Staff are trained to report any knowledge or suspicion of money laundering internally to the MLRO. The MLRO then acts as the expert assessor, the gatekeeper. They review that internal disclosure, use their judgment and expertise to decide if there are indeed reasonable grounds for suspicion, and if so, they are the one responsible for making the formal suspicious activity report, SAR, externally to the National Crime Agency.
So they're the bridge between the firm staff spotting things and law enforcement.
Exactly. They filter and assess the internal intelligence and decide what needs to be escalated to the authorities. It's a role with huge responsibility.
And does senior management just leave the MLRO to it, or do they have oversight?
No, senior management has a clear oversight role. They are required to formally request reports from the MLRO at least once a year.
What's in those reports?
They should cover how well the firm's AML systems are working, any problems or weaknesses identified, the level of risk the firm faces, details of training, maybe statistics on internal disclosures and SARs filed. Senior management then has a duty to consider that report and take action to address any issues or strengthen controls. It ensures AML compliance remains visible and accountable right at the top of the organization. It's not just delegated and forgotten.
Fostering that culture of compliance from the top down.
Precisely.
And all of this relies on staff actually knowing what to look for and what to do, which brings us back to AML training. You mentioned it's a requirement. How important is it really? Is it just a tick box exercise?
It absolutely should not be a tick box exercise.
Yeah.
Effective training is fundamental. It has to be provided regularly, not just once when someone joins all relevant staff, people handling transactions, dealing with customers, compliance teams, even managers.
What should the training cover?
It needs to be comprehensive. It must cover the actual laws and regulations, the firm's own internal policies and procedures, how to spot red flags, who the MLRO is, how to make an internal report. Crucially, it must also cover the personal consequences for staff if they breach the rules, potential disciplinary action, fines, even criminal liability. Understanding the stakes involved is key.
So it's about awareness and empowerment.
Exactly. It's about embedding that culture of vigilance we talked about, making sure every relevant employee understands their role in protecting the firm and the financial system, knows how to recognize suspicious activity, and feels confident and empowered to report it without fear of repercussions. It turns every employee into a potential line of defense.
Okay, so what happens if all these systems fail? If firms don't comply, or individuals get involved in laundering or enabling it, what are the actual consequences?
The penalties, they sound pretty severe from what you've said. They're designed to be severe, very severe deterrents. For those main offenses under POCA, concealing, arranging, acquiring criminal property, the maximum penalty upon conviction is 14 years imprisonment, or potentially an unlimited fine, or both.
14 years, that's significant.
Extremely significant. It puts money laundering on par with other very serious crimes. It sends a very clear message about how seriously the UK takes tackling illicit finance.
And for tipping off, warning the suspects.
That also carries a hefty penalty, reflecting how damaging it is. Up to 5 years imprisonment, or again, an unlimited fine, or both.
So how do these penalties work as a deterrent? Is it just aimed at the main criminals?
That's an important question. They act as a deterrent on multiple levels. Yes, they target the criminals directly involved in the underlying crime and the laundering itself, but they also target the professional enablers, the lawyers, accountants, etc., who might be tempted to facilitate laundering. And critically, They also act as a deterrent for negligence within regulated firms. The risk of prosecution or massive fines encourages firms and individuals to take their compliance duties like reporting suspicions extremely seriously. The cost of getting it wrong or turning a blind eye is just too high.
What about the people running the firms? Partners, directors, can they be held personally liable?
Yes, absolutely. Accountability goes right to the top. If partners or directors are found to have failed in their duty to disclose suspicions or are complicit in offenses, they can face specific penalties, including prison sentences up to 2 years in some cases, or significant civil penalties and fines from the regulator.
So the FCA can penalize individuals too.
Yes, the FCA has strong powers to fine individuals, ban them from working in the regulated sector, and issue public censures. If a firm has systemic AML failures, the senior managers deemed responsible can face serious personal consequences. It reinforces that leadership must prioritize and oversee compliance properly.
Okay, one final area to cover, which is related but distinct. The Bribery Act 2010. This tackles corruption, but often corruption and money laundering go hand in hand, right?
Yeah, they very often do, yes. Bribery generates illicit funds that then need to be laundered. The Bribery Act 2010 was landmark legislation, creating a modern and very tough legal framework to combat bribery both here in the UK and internationally by UK entities.
What's the main offense it prohibits?
The core offense is offering, promising, or giving a financial or other advantage to someone else. The key is the intent. It must be done with the intention of inducing that person to perform a relevant function or activity improperly, or to reward them for having already done so. It also covers the other side, requesting, agreeing to receive, or accepting a bribe.
Okay, improper performance. That sounds like it could be subjective. How is that defined?
It's defined quite broadly to capture breaches of trust or expectation. It means performing a function or activity in a way that breaches an expectation of good faith, impartiality, or acting in accordance with a position of trust. The test is objective. What would a reasonable person in the UK expect in terms of how that function should be performed?
So it's not just about outright cash bribes.
No, definitely not. It covers any advantage. Lavish gifts, excessive hospitality, job offers for relatives. If the intention is to improperly influence someone's actions, it could be bribery. So what does this mean for everyday business? It means companies need to be really careful about gifts, hospitality, and other benefits, ensuring they are reasonable, proportionate, and not intended to corruptly influence decisions. It's a careful line to walk.
And does this act only apply in the UK or to public officials?
No, its scope is incredibly wide. It applies to bribery relating to any function, public or private, and crucially, it has extraterritorial reach. It applies to bribery committed outside the UK if it's done by a person or company with a close connection to the UK, like a British citizen or a UK-registered company.
So a UK company could be prosecuted for a bribe paid overseas by an employee or agent?
Yes, absolutely, even if nothing happened on UK soil. And importantly, the Act introduced a specific corporate offense, failure of a commercial organization to prevent bribery. A company can be found guilty if someone associated with it, like an employee, agent, subsidiary, pays a bribe intending to benefit the company. The only defense is if the company can prove it had adequate procedures in place designed to prevent bribery.
Putting the onus on companies to be proactive.
Exactly. It forces companies to implement robust anti-bribery policies and controls.
And the penalties for bribery, are that tough?
Very tough. For individuals, the maximum penalty is 10 years imprisonment and an unlimited fine. For companies convicted of failing to prevent bribery, the penalty is an unlimited fine, which can be absolutely massive, potentially crippling the business. It reflects the UK's very strong stance against corruption.
Wow. Okay. We have covered a huge amount of ground today. It's gone from, spotting suspicious activity at an airport right through to the complexities of international law and corporate liability.
We really have. We started by defining what money laundering actually is and looked at some of those clever, sometimes quite subtle methods criminals use structuring deposits, using investments, paying off loans, trying to make dirty money look clean.
Yeah, and then we dove into the legal nuts and bolts here in the UK. POCA, with its core offenses concealing, arranging, possessing, and those crucial duties like reporting suspicion and the big no-no of tipping off. Plus, the Terrorism Act's focus on cutting off funds for terrorism.
And we saw how the EU directives built on each other over time. The third setting definitions, the fourth bringing in the risk-based approach, PEPs, tax crimes, and importantly, beneficial ownership registers. Then the fifth, tightening rules on e-money and making ownership data even more public. All steps towards greater transparency and control.
Then linking that to the global picture with FATF setting the standards, evaluating countries, pushing for worldwide action because crime doesn't respect borders, and bringing it right down to the practical level with customer due diligence, why firms need your ID, but also how they try to balance that with not excluding vulnerable people.
Exactly. And finally, looking at the guardians, the SCA setting the rules and enforcing them, and the vital role of the MLRO inside firms, coordinating the response, supported by well-trained staff. All backed up by those very significant penalties for getting it wrong, whether it's money laundering or bribery. You really should now have a much clearer, more nuanced picture of this whole complex system that's working, constantly evolving to try and keep our financial world safe and trustworthy.
Absolutely, protecting the integrity of the system for everyone.
But what's truly fascinating here, and maybe the thought to leave with, is that this is a constant battle. The criminals are always looking for the next loophole, the next technological edge. They adapt incredibly quickly.
So the regulations have to keep up.
They have to try, which raises a really important question for the future, doesn't it? As technology gallops ahead, think about the anonymity offered by some cryptocurrencies, the rise of decentralized finance, DeFi, operating outside traditional systems, maybe even sophisticated AI being used to create fake identities or manipulate markets. What new, perhaps unforeseen challenges will emerge in this fight against money laundering? And how will these frameworks, these laws and controls we've discussed today, need to evolve again to stay not just relevant, but actually effective against the threats of tomorrow?